listen to me very carefully, because what I'm about to tell you could save your family hundreds of thousands of dollars, or cost them everything if you get it wrong. I am Kevin O'Leary, and for over 4 decades, I have been the architect of fortunes. I have spent a lifetime building wealth, constructing ironclad fortresses around that wealth, and ensuring it passes to the next generation intact. I have guided hundreds of families through the treacherous waters of estate planning. I have witnessed the triumphs people who navigate the storm perfectly, and I have watched in horror as people take a sledgehammer to their family's financial future with one single catastrophic blunder. And today, I am going to reveal the solitary, most devastating tax error people commit when trying to hand the keys of their kingdom to their children. Now, before I hand you the map to the treasure and show you exactly where the landmines are buried, I need a commitment from you, right now. Look at that subscribe button. Obliterate it. Smash it. Because this channel isn't just content. It is a fortress for your money. It is a shield for your bloodline, ensuring you don't get fleeced by taxes you have no obligation to pay. I don't deal in fairy tales or sugar-coated advice. I expect you to move. So, subscribe, lock in those notifications, and let's ensure the IRS doesn't feast on your family's fortune. Picture the landscape of America right now. It is a unique moment in history. Millions of baby boomers are sitting in homes that have exploded in value, appreciating massively over the past 30, 40, even 50 years. You bought that colonial or that ranch in 1985 for a modest $80,000. Today, it is a winning lottery ticket, sitting on a concrete foundation worth $600,000, maybe $800,000, maybe even more. That is glorious. That is the American dream realized. You played the game and won. You bought when the market was quiet. You killed the mortgage. You polished the diamond. And now, you are sitting on a gold mine. But there is a shadow looming over that house. Most of you are walking blindfolded, completely clueless about how to transfer that massive wealth to your offspring without the government carving out a massive, bleeding chunk of it. And when I say massive, I mean life-changing amounts of money. I see this tragedy unfold constantly. Good, salt-of-the-earth people who followed every rule. They secured the deed, paid off the bank, raised their family, and lived the dream. Now, they simply want to pass that torch to their kids. It sounds so clean, doesn't it? It should be simple. You earned it. You own it. The tax man should keep his hands in his pockets. But that is a fantasy. That is not how the machine works. This is the kill zone. This is where people make errors that bleed their children dry, tens of thousands, sometimes hundreds of thousands of dollars, vaporized in completely avoidable taxes. And the true tragedy? The parents don't even know they inflicted the wound until it is far too late to stitch it up. Your home is likely the titan of your portfolio. For most Americans, that structure represents 50, 60, maybe 70% of their total net worth. Let that sink in for a second. 70% of your life's work is locked in those 4 walls. So when you screw up the transfer of that asset, you aren't making a typo. You are wiping out a legacy. That is unacceptable, and I refuse to let that happen to you. I can hear the gears turning in some of your heads right now. Kevin, I've got a plan. I'll just scribble my kids' names on the deed while I'm still breathing. Problem solved. I'll make them co-owners, and when I fade away, the house slides to them. No lawyers, no courts, no hassle. Stop. Freeze right there. That thought, that is the poison. That is exactly the mistake I am warning you against. That is the single worst financial move you can make, and I'm going to dissect exactly why in agonizing detail so the thought never crosses your mind again. But first, if a cold sweat is starting to form because you're realizing that maybe estate planning is a darker forest than you thought, if you are starting to see the complexity of the beast, do me a solid. Hit that like button right now. It signals the algorithm to push this message to people who need saving. And talk to me in the comments. Do you own a home? Are you planning the handoff? Did you already sign the deed? Let me know. I am in those comments. I want to hear from you because your situation might just be the lighthouse that saves someone else from crashing into the rocks. All right, let's dissect the beast. Let's look at the biggest mistake people make, the mistake that incinerates more family wealth than almost anything else in the world of estate planning. The mistake is this: adding your children to the deed of your house while you are still alive. People do this constantly. I mean, it is an epidemic. It is likely the most common estate planning tragedy in America. They think they are being clever. They think they are dodging the probate judge. They think they are outsmarting the system. But what they are actually doing is walking their children into a tax ambush that could cost them $100,000 or more. Here is the anatomy of the disaster. When you add your kids to the deed while you are breathing, you are legally making a gift. And when you gift property, the recipient inherits a curse called your cost basis. Let me break down what that means, because this is the bedrock of everything I am about to tell you. Cost basis is essentially what you originally paid for the property, plus the sweat equity and cash you poured into improvements over the years. Let's run the numbers. Let's say you bought your castle in 1980 for $100,000. Over the decades, you dropped $30,000 on a chef's kitchen, added a bathroom for $20,000, slapped on a new roof for $15,000, and finished the basement for $25,000. Your total cost basis is $190,000. But today, after 40 years of the market marching upward, your house is worth $750,000. Now, here is where the nightmare begins. If you add your kids to the deed now and gift them the house while you are alive, they inherit your ancient cost basis of $190,000, not the current value of $750,000, your basis. The numbers from 40 years ago. Fast forward. You pass away a few years later, your kids decide to sell the house. Maybe they have lives in other states. Maybe they don't want the memories. Maybe they just need the cash. Whatever the reason, they sell it for $750,000. Guess what happens next? The taxman steps in. They have to pay capital gains tax on the difference between the sale price and that old dusty cost basis. That is $750,000 minus $190,000. That equals $560,000 in pure taxable profit. Let me translate that into pain. At the current long-term capital gains rate, which is 15% for most, but can jump to 20% if your kids are successful. High earners, we are talking about writing a check for $84,000 to $112,000 to the federal government alone. And if you live in a state that loves to tax income, add another 5%, maybe 13% if you are in the People's Republic of California. In California, your kids could be handing over close to $185,000 in total taxes on a house you already owned, on wealth you already created, just because you made one mistake trying to be helpful. Let me say that again so it burns into your memory. If you gift your house to your kids while you are alive, they could pay close to $200,000 in taxes when they sell it. Does that sound like a brilliant plan? Does that sound like you are protecting your legacy? Because you aren't. You are destroying their inheritance. You are handing a massive slice of their birthright to the government for absolutely no reason. Now, here is what makes my blood boil about this whole scenario. People do this because someone whispered in their ear that it avoids probate. A neighbor over the fence, a friend at the bar, maybe even a financial advisor who has no business giving legal advice told them, just add the kids to the deed. It'll skip probate. And yes, technically, it does avoid probate. But do you know what probate actually is? It is simply a legal process where the court supervises the distribution of your estate. It takes time. It pushes some paper. It costs a little money. How much? In most states, maybe $3,000 to $5,000 for a typical estate. Maybe it drags on for 6 months to a year. So let me get this straight. You are so terrified of probate, a process that costs maybe $5,000 and takes a few months, that you are willing to burn $150,000 or $200,000 of your children's money in taxes? That is insanity. That is like being so afraid of a parking ticket that you drive your car off a cliff. The cure is 100 times more lethal than the disease. But wait, it gets darker. Here is the other problem with adding your kids to the deed while you are alive, a danger most people are blind to. You are opening the gates to risks that have nothing to do with taxes. You are exposing your sanctuary. If your kid gets sued for any reason, a car wreck, a business deal gone wrong, anything, guess what? That house is now their asset. It can be seized to satisfy a judgment. You just took your safe, protected, paid-off fortress and threw it into the legal grinder. If your kid goes through a divorce, and let's be real, Statistically, half of marriages end in flames. Guess what happens in most states? That house is now a poker chip in the marital estate. It can be split with their ex-spouse. Your son or daughter's ex could end up owning half of your bedroom. The house you worked 30 years to pay off, the house you raised your babies in, half of it could go to someone you can't stand, someone who isn't even family anymore. Is that the legacy you want? If your kid has creditor problems, files for bankruptcy, makes bad business bets, that house is exposed. It is fresh meat for creditors. You just took the most valuable diamond you own and threw it into the shark tank of your kid's financial life. Every risk they take, every liability they carry, now threatens the roof over your head. Brilliant move. Not. And let me tell you something else the experts forget to mention. Once you ink your kid's name on that deed, you cannot just scrub it off if you change your mind. You need their permission. They have to agree to sign the property back to you. What if you have a falling out? What if the relationship turns toxic? What if they make life choices you despise and you want to change the plan? Too bad. You surrendered the captain's chair. You are stuck. What if you have to sell the house to pay for your own long-term care? Nursing homes are brutal. $8,000, $10,000, $12,000 a month. What if you need that liquidity and your kid refuses to sign the sale papers? What if your kids are at war with each other about whether to sell or keep the property and they are deadlocked? You just gave up control of your life raft. At 70, 75, 80 years old, you are now at the mercy of your children, their spouses, and their financial desperation. Is that really the position you want to occupy? I certainly wouldn't. I have seen this dynamic shatter families. I've seen it in my own circle, parents who thought they were being proactive, only to find themselves trapped when they needed to sell for medical expenses, blocked by a child who wants to hoard the inheritance, or a spouse whispering in their ear. It is a nightmare, a complete, preventable nightmare. So, if gifting the house while you are alive is the poison, what is the antidote? What is the right move? I am going to tell you. But first, let me explain the magic of a concept called the step up in basis. This is the key to the kingdom. This is the secret weapon that safeguards your family's fortune. This is what separates the sophisticated from the reckless. Pay attention, because this is the most critical minute of this entire broadcast. When you die and leave your house to your kids through your will or a trust, your kids receive a gift from the tax code called a step up in basis. That means the cost basis of the house is wiped clean and adjusted, stepped up to the fair market value on the date of your death. Not what you paid for it 30 years ago. Not your old basis. The current market value. Let me run that same example so you can see the massive shift in wealth. You bought for $100,000. You poured in $90,000 in improvements. Your basis is $190,000. The house is now worth $750,000. You pass away, leaving the house to your kids through your estate. On the date of your death, the house is appraised at $750,000. That number becomes your kid's new basis. 75万美元, not $190,000. Now, if they turn around and sell the house 6 months later for $750,000, guess how much capital gains tax they pay? Zero. Nothing. Not a single red cent, because there is no gain. The basis is $750,000, and the sale price is $750,000. No gain equals no tax. Even if they wait a year and the house ticks up to $780,000, they only pay tax on that tiny $30,000 sliver of gain. That's maybe $4,500 to $6,000 in taxes instead of $150,000 or $200,000. Do you see the magnitude of the difference? Do you see why the step up in basis is the most powerful tool in your arsenal? Do you understand why every competent estate planning attorney in America will scream at you not to gift your house while you are alive? By doing nothing, by simply holding the line until you pass, you save your family hundreds of thousands of dollars. You don't have to be a genius. You don't need a law degree. You just have to not screw it up. This is what I mean when I say that in estate planning, sometimes the best move is to stand still. Don't try to be clever. Don't try to hack the system. The system has already handed you a golden ticket. The step up in basis is a gift. It is legal. It is built into the bedrock of the law. All you have to do is not ruin it by gifting your assets prematurely. Now, I can already hear the objections. But Kevin, I despise probate. Probate is expensive. I heard horror stories. Okay, I hear you. Probate can be a drag. In some states, it's a bureaucratic swamp. In California, the fees are predatory, based on a percentage of the estate value. But here's the reality check. Even in the worst-case scenario, probate is still cheaper than losing the step-up in basis. Way cheaper. But you know what? You don't even have to choose. You can have your cake and eat it too. You can dodge probate and keep the step-up in basis. How? You put your house in a revocable living trust. This is the solution. This is the holy grail. You avoid the courts and you preserve the tax break. This is what the smart money does. This is what I do with my own empire. This is what every wealthy individual in America utilizes. A revocable living trust is simple. You create a legal document, the trust agreement. You name yourself as the trustee, meaning you hold the reins. You transfer your house into the trust by signing a new deed. And you name your kids as the beneficiaries who grab the baton when you fall. That's it. Simple. During your lifetime, nothing changes. You are still the captain. You can sell, refinance, take out equity. You do whatever you want because you are the trustee. You are in control. But when you die, the magic happens. The trust owns the house, not your personal estate. So it bypasses the probate courts entirely. No judge, no waiting, no fees. The house slides directly to your kids according to your rules. It is quick, it is private, and it is clean. And here's the beautiful part, the part that saves your family a fortune. The house is still included in your taxable estate, which means your kids still get the step-up in basis. The IRS treats it as if you owned it when you died, which you did, through the trust. So, your kids get the stepped-up basis to the fair market value. You avoid the probate headache, and you avoid the tax nightmare. It is perfect. Yes, setting up a revocable living trust costs money. I'm not going to lie to you. Depending on your zip code and the complexity of your life, you might pay $1,500 to $3,000 for a top-tier attorney to draft the documents and help you move the assets, maybe more in the big cities. But look at the ROI. You spend $2,000 to save potentially $200,000. Show me another investment on this planet with that kind of return. Show me where else you can turn $2,000 into $200,000 of value for your bloodline. You can't, because it doesn't exist. This is the no-brainer of all no-brainers. Every homeowner who wants to pass their legacy down should have a revocable living trust. Period. End of story. If you don't have one, you are leaking money. And the longer you wait, the higher the odds that something happens and it becomes too late to patch the hull. Now, let me address another trap. Some people think they can cheat the system by just adding one kid to the deed as a joint tenant with right of survivorship. They figure, when I die, the house snaps to that one kid. No probate. Then that kid can share the money with the siblings. Wrong. Wrong on multiple levels. First, you have the same tax problem. No step up in basis for the portion you gifted. If you add one kid as a 50% owner, they get your old, low basis on their half. When they sell, they get hit with the tax bill. Second, you have just engineered a family civil war. One kid owns the whole house after you die, and the others have to just trust that kid to be fair. What if that kid decides, Mom and Dad like me best, I'm keeping it? What if their spouse pressures them to hoard the cash? What if there is already tension? You just threw a stick of dynamite into your family living room. I have seen siblings who were best friends stop speaking forever over this exact scenario. One sibling holds the deed, the others feel betrayed, and the family tree is set on fire, all because the parents thought they were being clever. Here's the bottom line. In the simplest possible terms, the IRS offers you an incredible gift, the step-up in basis, if you just leave your assets in your estate when you die. But you have to actually die owning the assets, either directly or through a revocable trust. If you give them away before you take your last breath, you lose the step-up. The rule is binary. Die owning it, get the step-up. Give it away early, lose the step-up. So the strategy is obvious. Hold the line, put the assets in a revocable trust to skip the courts, name your kids as beneficiaries, and let your heirs inherit the tax-free step-up. This is estate planning 101. This is the foundation. And yet people screw it up every single day because they listen to rumor and hearsay instead of a qualified professional. Let's look at the real world. In the Bay Area, a house bought for $200,000 in 1985 is now worth $2 million. If you gift that house early, your kids face a capital gain of nearly $2 million. The tax bill, federal plus California state tax, could be $649,000. $649,000 gone, vaporized, because you made one mistake. But if you use the trust, zero tax. You save your family over $500,000. That is generational wealth. That is college tuition for the grandkids. That is down payments for everyone. That is life-changing money. And you're going to flush it because you didn't want to pay a lawyer $2,000? That is madness. And for those worrying about the estate tax, stop. Unless you have over $13, $6 million, or over $27 million as a couple, the federal estate tax is a ghost. It doesn't exist for you. Don't let fear of a tax you will never pay push you into a mistake that guarantees you will pay capital gains. If you have already made the mistake, fix it today. Deed the property back to yourself. Have your kids sign a quitclaim deed. Get it back in your name, then set up the trust. It might cost a few bucks to fix, but it is a tiny price to pay to save a six-figure tax bill. Do not procrastinate. Here is your battle plan. Step 1. Do not add your kids to the deed while you are alive. Step 2. Find a shark of an estate planning attorney, someone who specializes in this, not a generalist. Step 3. Build the revocable living trust. Step 4. Fund the trust. Actually move the house into it. Step 5. Review it every few years. 5 steps. You can execute this in 30 days. And once it's done, you sleep like a baby knowing your legacy is bulletproof. I've been in this game 40 years. I know what works. This works. Protect your house. Protect your family. So here is my final challenge to you. If you are ready to stop making expensive mistakes, do 3 things. Subscribe to join this community of wealth builders. Smash the like button to save others from this disaster. And leave a comment. Do you have a trust? Are you getting one? Let me know. Don't throw away a lifetime of hard work. Set up the trust. Preserve the step up. Save the fortune. That is the secret. Now, go make it happen.